we like non-bank financials that are broadly diversified banks. I think banks that are reliant only on deposits are playing a dangerous game. Deposit competition is so much more fierce than it was 5, 10, 20 years ago. You have non-banks, you have online banks, you have credit card companies. Everybody's competing for deposits, and that's the cost of goods sold for a bank. And with all this competition, these mid-sized banks that aren't huge online asset gatherers like the big money center banks, these mid-sized banks that have to compete and then rely on lending, they're paying more for deposits while the loan rates might be dropping. And that is somewhat concerning for me across the board. And I think we're going to see a wave of bank mergers as a result. But for investors, it's not going to be the kind of bank mergers we had 20 years ago where there were routine massive premiums paid. I think bank mergers will come out of a sense of survival or better competition, and it won't be very rewarding to shareholders. They're going to be looked upon to cut costs. The diversified banks with capital markets, with trading, with asset management, with huge online deposit gathering machines, those we like a lot better than your typical regional or even the community banks.
Got it. Mark, so you're saying there may be consolidation in small and regional lenders, but there are no arbitrage opportunities from M&A. I hear you. One area I note you are staying away from is private credit. Folks have been talking about leverage upon leverage upon leverage in private markets, especially private credit. And I got to ask you bluntly, is that the place where potentially we could have a credit event emerge that could just undermine this entire market?
Well, that's a great question. I don't think the private credit market is big enough to cause anything close to a systemic failure, but it can cause pain for individual investors. I was a lender at Bank of America SunTrust prior to the wealth management side, and I remember how diligent you have to be with pricing loans. Banks turn a lot of loans down. They don't turn them down because they're foolish. They turn them down because somewhere the credit doesn't make sense from a cash flow or from a secondary collateral standpoint. To think that private lenders come in, step in, and can across the board find very strong credit quality companies that are willing to pay a higher rate of interest, and those do not carry more risk, that's a fallacy. There is more risk. That's why these companies pay more interest. And in a booming economy, that can be fine. But when the risk hits the fan, those credits, remember, banks, if they have more than 1 or 2% of their loans go bad, they don't make a profit. So I'm very concerned about private credit. I think they might have stretched a little. I think these entities that package it and sell it don't retain a lot of the risk all the time, and they collect fees and they move on to the next deal. So I think investors should be very careful about private credit. To me, it's a Wall Street contrivance. At its worst, at its best, you have to stick with the best issuers. But across the board, I'm cautious on thinking private lenders know a lot more than traditional bankers.